post it in our Google discussion forum. Is my screen visible?
Yes.
So, hello everyone. Welcome to this week's live session for our course on corporate finance. So today we will be discussing like what we have learned post week 8. So I will be giving a brief recap and rest we will cover in next. So in week 9 we discussed about exchange rates. So I just wanted to give you an overview like in practice sets this terminology was used, so like INR to CNY or INR hyphen CNY exchange rate, yeah, CNY hyphen X INR. So when in this form exchange rates are mentioned, then the currency which is coming out first, that is considered as home currency, and currency which is coming out to be like which is mentioned afterwards, that is the foreign currency. So for example, if you go to Google and search for INR to CNY exchange rate, then it will show you like how much one Indian rupee is valued in terms of Chinese yuan. And similarly, if you search for CNY INR exchange rate, then it will show like how much one Chinese yuan is valued in terms of Indian rupees. That is 11.64. So this is the terminology which is generally used, and that is used in our practice sets also. I just wanted to make it clear for all of you. I think this was not discussed. So in our lectures, we use like in like domestic and foreign currency. So the currency which comes first, that is domestic, which comes second, that is foreign currency. Please take this in your mind when you are solving for these questions. So let's take a few examples. Like we did not do many examples of on these exchange rate topics in our previous live session. So let's take a few examples. So for example, if question asks like if one Chinese yuan is equal to 15 Indian rupees, and you have given GDP deflator which are like price levels in like in if price level in India is 110, and if the same is 120 in China, then what is the real INR to CNY exchange rate? So you can easily solve. The key point to note is like here we are asking about INR to CNY exchange rate. So India is home country and China is foreign country. So if we use their terminology, then the nominal exchange rate, which is like 1 CNY to 15, so 1 INR will be 1 by 15 CNY. So this is 1 by 15 is your nominal exchange rate. You multiply it by P star, like home currency price level divided by foreign currency price level, and you get like the real exchange rate of in INR CNY is like 0.0611. If you reverse the question, so for example, earlier I asked question asked like real INR to CNY, but if it asks like CNY to INR exchange rate, so now China will become your home country domestic currency, and India will be foreign currency, and you think in that terms. So here the nominal exchange rate is 15 only, and then P is 120 because China is your home country, and 110 is your foreign like price level, and you solve and you find that real CNY to INR exchange rate is 16.36. Is that clear to you?
Yes. Yeah.
Okay. And in exchange rates, like by solving for no arbitrage conditions for interest rates, we derived this interest parity condition, which says interest like which is a relation between exchange rates and interest rates in home and foreign currency. So this is the normal equation for interest parity condition, and by doing like calculations we derived this same in our real exchange rate and real interest rate terms also, which is the second in real terms that is also given here. And to do a like, let's have an example on this thing also. Like if question says like is the prevailing interest rate in India is 10% and prevailing interest rate in China is 8%, then what is the expected rate of appreciation of the INR CNY exchange rate? So here India is your home and CNY China is your foreign country. Okay. So how do we solve that? So what we do, like in lectures we saw that we rearrange this our interest parity condition and then we derive a relation for like domestic interest rate, foreign interest rate, and the expected rate of appreciation of our exchange rate. So if you rearrange, so for example in like the you can rearrange your interest parity condition in the given equation. So 1 plus it, and you like you bring et to downwards and then you can rearrange it to in this form like 1 plus et plus 1 expected next period exchange rate minus exchange rate divided by exchange rate. So this the whole term is this is your expected rate of appreciation. So you can solve for like using these values, like the here India is your home country, so IT is 10%, IT star is 8%, and you can solve for expected rate of appreciation, which comes out to be one like minus 1.82%. So here like INR CNY exchange rate is not appreciating, but it is depreciating by 1.82%. So I think this question is clear to you. Okay.
Yes.
Any other questions you if you have regarding exchange rates, any doubts, any confusion you have, you can raise them here. Then we will move our discussion to like
Yeah.
derivatives like options.
Yeah. No, week 9, I didn't do well in the GA because that was not well, but the concepts I understand quite well because of my work also. So
Okay, sure. So like the in week 9 mainly we discussed about exchange rates, foreign capital markets, how financial crisis happen, like how like markets are interlinked internationally, how like currency areas are formed. Those are theoretical discussions which we like revised in our last live session also. Now coming to week 10, in week 10 we started our discussion regarding derivatives market, and particularly we discussed about options. So what is an option? So option is like option. So for example, there are two types of options. One is call option and put option. So a call option gives the holder the right to purchase an asset. This asset can be your stock, your like the it can be specified on like various types of securities, yeah, assets. So for example, nowadays there are options specified on electricity prices, your on your weather conditions, etc., etc. But generally, like these are specified on your stocks and index, like market index. So a call option gives its holder the right to purchase an asset for a specified price, which we call strike price or exercise price, on or before some pre-specified date, which we call as expiration date. And the purchase price of this option is called the premium. So we will call like call premium or put premium in our discussions. And similarly, like this was the call option, and the put option gives the right to sell the particular asset on a pre-specified price on or before the expiration date. We can take we can have a look at some examples. For example, like first one is an example of a call option. So it says like a 3-month call option. So 3 month is your expiration date, so you can exercise this option within 3 months, either like within after 3 months you will not be able to like use this right. And the key term is right. It is not an obligation, it is your right. So you can either use this right or you cannot use this upon your, like, your choice. It is your choice whether you want to like exercise your right or not. So if, like, if you say like the first example is a 3-month call option on Tata Motors with a strike price of 820 rupees, and its price is 10. So 3 months is your expiration date. Your strike price or exercise price is 820 rupees, and price of this call option is, like, if you want to have this right, you have to give 10 rupees. So the call premium is 10 rupees. And an example of put option is like a March 2025. So currently it is December. So March will be, so it is also like a 3 month. So it can be specified in terms of months also. And so a March 2025 put option on Nifty 50. So earlier it was specified on a particular stock. Now it is specified on a index, market index, that is Nifty 50 with a strike price of 25,000, and it is priced at rupees 20. So what this second option gives, like, if you have this put option, then you can sell your Nifty 15 index, like, on, like, 825,000 within, like, by the March 2025, and the put
Here,
premium
P
is,
should be 20, no?
sorry,
P should be 20, right? In this second example.
yes, P should be 20, yeah. So this is the, like, the these are the notations which we will be using. So for call price or put price, we use C and P respectively. For strike price, we use X to specify that. We use capital T to specify the expiration date of options, and we use capital S to denote the share price. Share, like, we share price or whatever the asset price which we are going to use. So in the second example, it is 25,000. So, like, the whatever the index price, index value is, that we will be denoting by capital S. Okay. Okay. So now there are a few terminologies like associated with options. So first is like, we there are three states of options depending on their cash flows. So if a option gives you positive cash flow, then we call it an in the money option. And if it gives you negative cash flow, we call it out of the money. And if it gives no cash flow, like zero value, then we call it at the money. So let's understand this concept with the example. So in the previous slide, we had like one call and one put option. So if the call option, if the share price for Tata Motors is more than strike price, that is 820, then it is more than 820, then it is in the money. How it is creating like positive cash flow for you. So what can you do? This call option has given you a to purchase this Tata Motors share at 820 rupees. But current market price, like on the expiry or like within your expiration period, your Tata Motors share price is more than 820. So what you will do, you exercise your options. So you will buy this Tata Motor. You are able to, you have the right to purchase this Tata Motors share as 820 rupees, and simultaneously you will sell in the market at price higher than 820. So you will have a profit of, like, whatever ST minus 820 will be your profit. So you are getting a positive profit, positive value by exercising these options. So that's why it is in the money when Tata Motors price is more than 820. And if its price is less than 820, then there is no meaning of exercising this option, because why will you purchase a particular share for a higher price than what it is available in the market, if it is available for the lower price in the market? So you will not exercise. That's why it is out of the money, because when you exercise, it will give you negative cash flow. So if it then you will choose, if you are rational, then you will choose not to exercise it. And at the money is when like the share price is exactly same to the strike price, that is ST equal to 820. Similarly, we can evaluate the put option also. So if like the index value is same as the strike price, then it is at the money. It will, if you exercise, or it will not give you any cash flow, like it will be zero. Like by like purchasing, like selling in the market, and like the exercising your option will give you the same cash flow, so there is no value. But if in the second case, if you have a put option and the market, in the market the index value is more than 25,000, then you will be having negative cash flow by selling this at 25,000, because you can sell it for a higher value in the market, because marketing is giving you higher value, so there is no way, no point of exercising your put option. So if your ST is more than your strike price, then put option is out of the money, and a rational investor will not exercise the put option. And if the market price of the asset is less than the strike price, then there is like positive cash flow if you exercise your put option, and your, in this case we call this to be in the money. So I think this concept is clear to you, like when we call them in the money and out of the money and at the money. Okay. Next, like there are two popular types of options, like which is, this definition is based on like how to exercise them. One is European and another is American. So European options are the ones which can only be exercised on the expiration date. So a particular date. So if we say like in the put example, so there will be a specific date, like for example 19th March 2025. So this European call option will only, can only be exercised on that particular date. But in the case of American option, you can exercise this on or before. So it gives you that flexibility, and because of this, it is intuitive to expect that the American options with the same features will have a higher price. They will cost you more because these are flexible. You can exercise them at any time. And we have already discussed this value of options at expiration. So for a call options, you will only exercise when, you will only exercise your call option when your share price is more than your strike price, and otherwise you will not exercise. So in other cases, your value of that call option will be zero, and when this is your share price is more than strike price, then ST minus X is your value of your call option. Similarly, for the put options case, if your share price, your asset price is less than strike price, then only you exercise your put option, and X minus ST is your value in that case, and zero otherwise. You can also look at like, these are the value, not the profits. What will be the profit? For profit, you need to subtract the price that you paid for call or put respectively. Okay. I think this is clear to you. Like you should be able to differentiate between value and the profit which you earn on options.
So I had a question on the graded assignment. So
Yes.
there's a thing about the writer of a put option. What is their maximum loss, right? So,
Yes.
and we were discussing, I said, if you're writing, there is no limit to the loss, right? You can have any amount of loss.
Yes.
But the option given puts a limit on that. The configured option is putting a limit on it. It's not unlimited, is not the right answer. GA question 2 or 3, I think.
Writer of a put option will have, okay, I will look into it. GA question number 2 or 3, I will look into it if there is some confusion. But I think that question was correct. Okay. So, okay, and one important term that appears is the writing the options. So writing in this context means like selling a particular put or call options. Like if you write a call option, then it means like you are selling that options. So these slides, like I will remove them, so this will come up, like upfront. So next we will be discussing the various strategies like involving options. So we have not covered the whole plethora of strategies, but a key important strategies we have discussed. So first strategy which we discussed is the protective put. So what we mean by protective put, like this involves like you buy one share of a particular stock and one put option. So for example, like continuing with our example, so you buy a put option with 3 month expiry on Tata Motors with the strike price of 820 rupees, and the price, the put premium is rupees 5. And you also buy like one share of Tata Motors, and the current price of the Tata Motors is 815 rupees 815. So let's exercise this strategy and what are your profits in various conditions. So if like there will be two conditions. One is like if your share price when your option like on your expiry, if your share price is more than 820 or if it is less than 820. So if it is less than or equal to 820, so then what will you do? Like you will exercise your put option because you are this is giving you positive payoff. And in that case, like exercising put option means like you need to sell one share of Tata Motors. So you will sell that at X. So your net value will be X, and the price you paid is S naught minus P. S naught is the initial price, that is 815. So for example, if on expiry the share price is 810 rupees, then your profit will be like you will be able to sell your say you will be able to sell your Tata Motors share at 820 rupees, which you are having, and this is the cost you incurred upfront, like 815 and 5 rupees for the option. So your net profit is 0 rupees in this case. Okay, and the counter of this is like if the share price on the expiry is more than your exercise price, that is 820. So in that case, like there is no point in exercising the put option. So you will be continuing to hold. You will not use this, and you will sell your share directly in the market, that is on price ST. So your profit will be ST minus S naught minus P. So if the share price is 830 rupees, your profit is 830 minus the cost, that is 815, and 5, that is 820. So your net profit is 10 rupees in this case. Okay, I hope this is clear to you. So in this, what you are doing, like you are kind of putting a cap on your maximum potential loss which you can have. So that is in this case is like if your share price is anything below 820 rupees. So for example, instead of 810, if your share price is 800 rupees, then also your profit is 0. So your loss is like you are not incurring any loss. But when share price increase, so if it is 850, then your profit will be 30 rupees. It will increase linearly in that case. A similar strategy like the earlier was involving a put option. Now a similar strategy is like involving a call option is like called the covered calls, in which what you do, you purchase a share of a stock and you sell or you write a call option on that stock. So for example, you write a 3 month call option on Tata Motors with strike price of 820 and the price of call option is 10 rupees, and you also purchase one share of.
Yeah, but
Sorry.
here it's saying put option, right? I think this is the
No,
question is
no, no,
about
no.
straddle.
Sorry, I mistakenly like this is the
Straddle
I
question, no? Yeah.
exchange. Yeah, yeah. So this is your example of covered call. So you write a call option. So I like the what you do, like you write a call option and you purchase a share. So what will happen? So this will, like I have mentioned it incorrectly in the question, so I will correct that when I will be sharing the slides. So in that case, what will be your profit? So if your share price is less than 820, what will you do? Like the you write the call option, but what the holder of the option will not exercise this because it is not profitable for him. So what will happen in this case? Like you will not have to pay anything to him, like in that case, but you got your call premium and your net value, like you will go to the market and sell your, like the stock in the market at price st. So your net profit is like st minus s naught plus c. So s naught is like the initial price at which you purchased, like you have bought one stock also at 815 rupees. So in that case, like if for example, if your market price of Tata Motors share is 810 rupees, then your profit is like 810 minus 815 plus 10 rupees which you received in terms of premium. So your net profit is 5 rupees. Similarly, if if the share price on the expiry is more than your strike price, then yes, hold, like the person whom you sold the call option, he will exercise the call option and you have to pay like him, you have to like give him the share at like the exercise price, that is x. So in that case, like what you will do, like the share which you own, like you purchased one share of the stock, so you will give that to the holder at price x. So x is your net value and profit will be x minus s naught plus c. So here, like for example, if the price of Tata Motors share on expiry is 830 rupees, then profit is like you are selling it on 820 rupees because you have to sell to the call holder. So 820 minus 815 and plus 10 rupees which you received in terms of call premium. So this will be your, like this will be your profit in this case. Okay, is this clear to you? Covered calls?
Yes.
Yeah. So and one more strategy which we discussed is the straddle. So what straddle do, like it involves like buying a one call and one put option with same strike price and same expiry. So what you will do, like you will purchase a call option and a put option with same, like the details. So 3 month call option with a 20 rupees strike price and 3 month put option with a 20 rupees strike price, and the price of call option is rupees 10 and price of put option is 5 rupees. So let's analyze this condition. So here also, like if share price is less than 820, in this case, like you will not exercise call but you will exercise put. So net value of put is x minus st in this case. So your profit will be x minus st minus the call premium minus put premium. For example, if your share price is 810, then your profit will be like 820 minus 810 minus 10 minus 5, your net profit will be minus 5 rupees. So you are incurring a loss in this case. In at the same time, like if your share price is more than 820 at expiry, then in that case you will exercise your call option but you will not exercise the put option. So net value in this case will be st minus x, and the profit will be st minus x minus the premiums which you paid. So for example, if your share price on expiry is 830, then 830 minus 820 minus 15, that is minus 5. So in this case, but if you notice, like if your, like the share price decreases more or increases more, so for example, if share price is 810, in that case you will have 5 rupees profit, and if your share price rises to 850, then in that case your profit will be like 25 rupees. So you have kept your losses at, like maximum loss will happen when both the options are on at the money. So that is like if your share price is 820, in that case you incur a loss of minus 15 rupees. Okay, so that is the maximum loss you will make. Two other strategies which involves like only options. One is the strip, which involves like buying two put options and one call options with same strike price and expiry. And another is strip, which involves like purchasing two call options and one put option with same strike price and same expiry. Is this clear to you, like these strategies and how we
Yeah.
evaluate these
Yes.
strategies?
Yeah.
Okay, give me 1 minute, so I will be back in 1 minute. Okay. Yeah, sorry for the delay. Okay. So next we discussed a very important equation, or that is derived by like no arbitrage conditions. So this is called the put call parity. So it is like the value of like the price of call option plus the present value of your exercise price should be equal to current share price plus the put premium or the put price. So how it comes? So like this is like involves like one strategy is like you are kind of borrowing X amount from the market and you are purchasing a call option, and second is like you are purchasing one share and one put option. These two strategy gives you same payoff, so their value should be equal in the market. So that is because of the because if it is not, then there is free profit available for the investors. So there will be arbitrage. So if no arbitrage condition should be there, then this equation should be like this. And we can use like we can use these equations to, like if we have call price with us, then how can we can also get the put price according to this equation. For example, a 3-month call option on Tata Motors with a strike price of 820 rupees is priced at 10 rupees. And if the current price of the Tata Motors is 815 and this risk-free rate or the interest rate is 5% per year, so then what is the put option price that has the same strike and same expiration? So we can use this put call parity to solve for this. And here you should take a note like this: T expiry is in terms of years. So you should make a note of that. So we can put the values. So 10 is the call option price, 820 is your exercise price, and you put all the values and it's solve for the put option price, that is 5.06 approximately. Like there are other values after the decimal also. So what does this define? So if your put option price is not equal to this one, then there will be a possibility of arbitrage. So if it is less than then you will go to the market and you exercise the second, this involving your strategy involving put options, and you will like you will have free profit in this case. So in equilibrium, this price would prevail. This is the meaning of this put call parity. Is this clear to you? This put call parity. Hello.
Yeah, yes, Abhinit is showing thumbs up.
Sorry.
No, Abhinit is showing thumbs up, so which means yes, yeah.
Okay, okay, yeah, I am in the full screen mode, so I am not able to see those thumbs up. Okay, so now like this is in the case like when the annual interest rates are given, but if your rates are given in continuously compounded form, then this like the here this 1 plus rt to the power t will be e to the power minus rt, like which we used in our continuously compounded interest rates case. So if in the question you are given as your interest rates in continuously compounded form, then you should use that form. So that this put call parity will become c naught plus x times e to the power minus r rf times capital T equal to s naught plus p naught. I will add that equation like in the slides when I will be sharing with all of you. Okay, so this was the discussion which we had in week 10. So in week 11 we started our discussion on pricing of options. So how different variables affect the prices of call and put options respectively. So there are 5 key variables involved with options. One is the stock price, that is the S naught. Second is the exercise price or the strike price, that is X. Volatility of stock price, like how variable the stock is in the market. Time to expiry and interest rates. And here I have defined like their relation with like call option and put option prices with these variables. So if stock price increases, then call option price of call option will increase and price of put option will increase, because if stock price increases, value of call option increases but value of put option decreases. Second is exercise price. So the it will be reversed in the case of what was the case with the stock price. So if exercise price increases, the value of call option decreases, so price of the call option decreases. And similarly, like with similar intuition, so if exercise price increases, price of the call put option increases. Another case is volatility of stock price. So we did a exercise in our during the lectures during the lectures, and we saw that like if volatility of the stocks volatility increases, then both put and call increases in value, so their respective prices also increases. With the time to expiry, call option certainly increases call option price, but on the put option it has ambiguous impact because it involves so with one like there are two things involved with time to expiry. So one thing like increases but another thing decreases, so that's why the put option price is uncertain if the time to expiry increases. And if the risk-free interest rate increases, then value of call option increases but value of put option decreases. And using these like the values, we can put some restriction on option prices, option values. So the first one is for the call option. So call option price should be at least equal to S naught minus present value of exercise price. And similarly for the put option, you can do the similar exercise which we did in the class, like forming the portfolio which have same payoff. And like in that case, like put option price should be greater than at least greater than or equal to present value of your exercise price minus the present current share price or the asset price. This part is clear to you? Okay.
Yes.
So next we discussed like various like the two important pricing models. So in today's session we will be like the covering the binomial option pricing concept, and in the next class we will cover the Black-Scholes pricing model. Okay. So what is the binomial pricing model? So it involves like the if we have the information that the option price can either increase or decrease to a certain multiplier. So for example, if it can increase by 20%, and if it can decrease by 10%. So this is the example. So if current stock price is 100 rupees, and we know upfront that price can either increase by 20% to 120 rupees, or it can fall by 10% and it can decrease to 90 rupees. So if this information is given to you, then you can use this information to value a call option with a given strike price and time to expiration. So these are the value at the expiry. So after 1 year. So if the expiry is 1 year, so after 1 year, if these are the condition is going to be, and you have this information, then what is the value of this call option? So how do we solve this? Like what we do, like we build two portfolios which have same payoffs. So, and one portfolio will involve the options and another will not have options in that portfolio. So for example, in this case, the first portfolio which does not involve options. So in first one, what you will do, like you will buy one share of stock and you will borrow like 81.82 rupees, which is the present value of 90 rupees. Like you will borrow 90 rupees at this rate, and so what the case required for this? So 18.18 rupees which you will be required to have, and another portfolio which you create, like in that what you do, like you write three call options, which is like you are selling three call options. And if you do the analysis, you find that the value or the payoffs of these two portfolio is same. And if the payoffs are same, then these two portfolio should cost you the same. Okay, so the first portfolio was costing you 18.18 rupees, and second portfolio is costing you the price of three call options. So these should be equal, and using this concept, you can find the call option price. So what essentially we are doing, like we are trying to find out the perfect, like the kind of, we are creating a risk neutral, like a condition in which there is no risk involved, like you are getting a certain payoff. So what how do we do that? We will do an example afterwards, like how we use this binomial option pricing. So in this example, like we had only the case, like the either it can increase or decrease, only one step was there, but there may be multiple steps involved, and we can like you can solve this using using the same method. You can you can solve it backwardly, and you can finally find the option price. And if it is continuously, so which is the case in the market, so in the market the prices are moving on a continuous basis, and so when we solve it for a continuous case, then we come up to the Black-Scholes model, which is the option pricing model, like the prevalent in in reality. So the main critical step in this binomial pricing model is like we are able to create a perfect hedge. Like we are able to find two portfolios which are having the same payoff. So like we are able to find such two portfolios. So we can like the incorporate both the portfolios together, and we will be like we will like the buy one portfolio and we will sell one, and we will have a certain payoff in that case. So what we do, like how do we create such a portfolio? For that, one thing we need is the hedge ratio. What is the hedge ratio? So hedge ratio is the ratio of like how many options are required to hedge, like the purchase of one, how many options are required to hedge against purchase of one particular share, one share. So how do we find this? So we find this by like the ratio. We find the hedge ratio is defined as the ratio of the range of the values of option to the like the values, like the range of the stock prices. So in the previous case, like the range for the stock prices was 120 minus 90, that is 30, and the range of call option values is like if stock price is 120, then call option has value of 10, and if stock price is 90, then call option value is 0 because you are not going to exercise that. So the call option range is 10. So in that case, like in this case, the hedge ratio is 1 by 30, like 10 by 30, that is 1 by 3. So like to hedge one purchase of one share, you need three call options. So that was the hedge ratio which you were having in our previous example. So what is the stages you need to like you what are the stages of finding the option prices in this binomial pricing model? So in the first stage, like you find these like the spread or the range of call and stock prices like cu minus cd, and you like the high stock price and lower stock price you find. Then you find this hedge ratio, and then you create a portfolio using like the h shares and one options. You can like increase like one share and one by h options, call options. And that like if you create such a portfolio, this portfolio will have a certain like the payoff of this portfolio will be certain. So you can have an example of that also. Like in the previous case, if you had a portfolio which has like one share and three call options, then in every conditions, like if your stock price goes to 120, then what will happen, like you will exercise, like the person who is there, he will exercise these options. Like you are selling, you are writing three options, so he will exercise, then you have to pay him 30 rupees. Okay, and if you have a long position on that, and so you are having like the 20 rupees in profit from your purchase of stock, so your net payoff is minus 10 rupees. In the second case, if like the stock price is 90 rupees, in that case what will happen? So in that case, like your payoff is 90 rupees in that case, because the value of your like the total you are having that stock with you, share with you. In the second case, when like your share price is at 90, then you will, the person whom you sold these options, he will not exercise these options. So the payoff from options is 0, but your share is now trading at 90 rupees, so value of your this portfolio is 90. In the first case was also 90. So if share price increases or decreases, in both cases your payoff is 90, so you are having a certain payoff. Now you have got this certain payoff, you can find the present value using the interest rates, and use like this present value of this certain payoff should be equal to like the cost of the portfolio, and using this, like you can solve for the option price. So let's take an example. So if question says like the current stock price is 100 rupees, it can either rise to 140 rupees or it can decrease to 80 rupees. And you have an option which says like the exercise price of 120 rupees, it expires in 1 year, and the prevailing risk-free interest rate is 10%. Okay. Now, like, we will solve this like this binomial price using binomial pricing, like step by step. In first step, like we like the calculate the like what are the call option values in like if price rises or if price falls. So if price rises to 140, then value of your call option is 20 rupees, like 140 minus 120. You will exercise your call option. But if price is like the price drops to 80, then you will not exercise your call option and value of your call option is 0. Okay. And now you can calculate your hedge ratio. Like hedge ratio is spread of call values, that is 20, divided by spread of your like the share prices, that is 140 minus 80, that is 60. So 20 by 60, that is 1 by 3. Okay. So now you need to create a portfolio like which involves like one share and three call options, because 1 by 3 is the hedge ratio. Similarly, like you can create like earlier I said like 8 shares and one written call option. So 8 shares is like 1 by 3 shares and one call options. So you like you can multiply this by a certain number. So I have multiplied it by 3. So in this case, like if this is your portfolio, then what is your certain payoff? So if your like there are two possible cases. If your price is 140 on expiry, then if price is 140, then what is the case? So your value of your you are holding one share, so value of that is 140, but you sold three options, and the person whom you sold, he will exercise because like the call option have positive value. So you the 20 times 3 value you have to pay to him, so your net payoff is 80 rupees in this case. In the second case, when the share price is on like the decrease to 80, in that case like the call holder will not exercise his option, and value of your portfolio is 80 in that case also. So like in both cases you have payoff of 80, so it is certain that you are having this payoff of 80. You can calculate the present value of that, that is 80 by 1.1, that is 72.72. This present value of your portfolio should be equal to like the cost which you are incurring at present. So what is the cost? So you are purchasing one, so 100 rupees for that, and you are writing three call options, so you are getting three times the premium on call option. So your cost is 100 minus three times the call option. This should be equal to the present value of certain payoff, and using this equation you can calculate the value of your call option price. So you understood this concept, like how do we use binomial pricing model to solve for like the option prices.
Yes.
Yeah. So for today's class, like we will be like I will be ending the session for till this point. In the next class, like I will continue from this point onwards. Like I will give a brief recap of binomial option pricing. Then we will move to Black-Scholes model, and then later on we will like the complete our discussion for like what we discussed in week 12. Okay. If you have
Sure. Yeah.
any questions, any concerns regarding like anything which we discussed today or any other like part of our course, like option pricing, like the fundamentals of options, etc., etc., you can raise them here and we can discuss them.
Yeah. Yeah. So that GA10 question 3, that is a thing, right? So the writer, it says that the maximum loss for the writer is strike price minus premium.
Okay, GA10.
Question 3.
Okay. So it says if an investor writes a put option, then what is her maximum potential loss? Correct? Is that the question which you are saying? Like,
Yes, yes.
so I think this is correct. Now, like if you are like you are writing a put option, that means you are selling a put option, correct? So you are receiving your put premium upfront. So you are receiving P. But what is the loss which you can incur? Like you will incur a like you are writing this put option. So this the person whom you sold this put option, he will exercise this option only when your stock price is less than your exercise price, correct?
Yes, but the price could be anywhere, right? Much, much less than the strike price.
Yes.
So if you simple put you have done without a protective put, so you'll have to buy the stock, right? So that way, that many things, it could be any part, right? Not just the exercise price, right? The strike, the stock price also matters, no? See, okay, let me understand from the side of the buyer, right? If a put
Yes.
option, if
Yes,
the
from the
pri-
buyer perspective, the price will matter. But from
no,
the
no, I'm
seller,
just
like, you are
no,
you are selling the put option. So what you are doing, like you are selling a right to sell. Like if the person exercises, then you have to give him, like you have to sell the said exercise price. Correct?
yes, you have to give them the share, right? But the share price could be anything, no? Or he will sell it to you at that price, but you will have to, but you won't be able to sell it, right? So that way the option, okay. So let me understand it from the buyer's point, then probably you can let me know why I'm getting confused. See, from
Yes.
the buyer's point, if
Yes.
share is, if the price is greater than X,
Hmm.
I'm not doing anything, right? I will just let the option go,
Hmm.
right? If the strike price is, sorry, if the price is less than the exercise price, less than equal to X,
Hmm.
I will exercise, right?
Yes, you
So
will exercise in it.
what is the profit I get? X minus ST.
Yes.
So the share price, suppose X is 100, the share price may be 80, 70, 60, even 20. So if my profit is X minus ST, then the writer loss is minus of that,
Correct. Correct.
right? Minus of X minus ST, or you can say ST minus X, however you put it, right?
Yes.
And
Yes.
so
Yeah.
that way the sales price also will matter, no? So that's why I was thinking it is unlimited.
Yes. Yes. Correct. Okay. Okay. I got your point. Correct.
Thank you.
So option B should be correct in that case. Yeah. Unlimited.
Yes, yeah. So actually, with this, to discuss with you, I use that number, but otherwise, I generally have this notion that if I am buying options, my profit is limited,
Hmm.
unlimited, my loss is limited. The loss is the premium I paid, right? Whereas if I am writing, right, my gain is limited. That is the premium I've received, but the loss
Yes.
could be unlimited. That is how I
Correct.
understood. Yeah. So
Correct. Correct. Correct.
mm, okay. So that was the one question I had. And Black Scholes, I also did not understand it. I know it, but the lecture I have to watch it once more to understand. So good
Yeah.
that you will cover it next time. By the time I would have read that and would have done the assignments also. I think the assignments are doing sometime early next week. So yeah, we would have covered that. Yeah.
So if you have any like in we have briefly covered the Black-Scholes model only, not in full detail. So what Black-Scholes is like, it is simply that equation which we have like we specify the assumptions regarding the Black-Scholes, and we simply use this like the equation for like the price of call options, like that is C equal to S naught times ND1 minus X e to the power minus RT ND2. So it is simply like earlier we derived like the call option price should be more than like this should be more than S minus X e to the power RT, correct? If like
Yeah, that's right. Yeah.
interest rates are continuously compounded. You simply multiply them with your some probabilities, like one is ND1 and one is ND2, and there are some formulas for D1 and D2, like these are based on the values of the options, like share price, exercise price, volatility, and time to expiry. And using that formula, like you can derive your option prices using that formula.
Great. Yeah.
That is
Thank
only
you.
like how do we derive, like for that like you need to like the derivation is very complicated for this Black-Scholes formula, like that involves the Ito's lemma and some doing some exercises. So basic underlying assumption in this is like as we discussed in like if binomial option pricing model, like we discussed only the one step case, and in the lectures we also solve for a two-step or three-step case. But like if there are multiple steps involved, like from your purchase of option to the expiry, if there are certainly multiple price movements will be there. So if it is continuously moving stop price, then the distribution of your share price is considered to be log normal. And using that assumption, like you derive this like the option pricing formula, like if you like iteratively solve that binomial pricing model, then you will get to this formula which we have in the Black-Scholes. So that is the underlying concept behind Black-Scholes formula. And for the sake of our for the sake of our course, like we will only be focusing on like you should have like you should know this like the formula only, and nothing complicated will be asked on this. But this is like we will be discussing Black-Scholes in our next live session also, like in detail. Like if you have any doubts regarding this, like you can ask me there, and if you have you can ask me here also, like what particular thing you don't understand regarding Black-Scholes.
No, I think I'll wait for the next call because I'll have to read it once more, or watch the video once more to even form the questions. So, thank you.
Yeah, sure. So in the final exam, like the I think I discussed with the instructor, and the like the bifurcation is like around 20% from like from week 1 to 7. So in quiz 2 we have not covered fully the week 8, like very few questions from week 8 was there. So from week 8 to 12, like the most of the final exam will be there, but there will be few questions from earlier weeks also. Okay.
Thank you. That helps quite a bit. Yeah, thank you.
Yeah, sure. Okay, thank you then. Like we will be meeting next week also. So will you guys have like will you be having session on the last week also, like after next week, or not required, like before just before the final exam?
We
It
can
could be
check
the,
with yeah.
Yes.
it could be the revision session only.
So if you guys want, then like yes, we can schedule this on the same time for the revision. And like we will be revising for from week 9 to 12 only, because we did revision for 1 to 4 and 5 to 8 previously before the quizzes. Yes, you're like, then I will schedule like we will have a session after week 12 also.
Okay.
Okay.
Thank you. And if you have turned off the recording, I had a question to ask about the marks distribution.
Okay, then let me turn off that, please.